Here we are, and look forward to catching up today. Here, everyone has started to pile in for the participants in, but let me give you a little bit of background about what we're here to do today. So we do these real estate market updates about once a month and talk about kind of the nuts and bolts of what's happening in real estate, what we're seeing on the ground, how we put, how we factor in national news, national housing data, et cetera. But what I wanted to do is get a little bit more holistic, kind of pull back and have a little bit broader discussion about what's happening in real estate here in Bend and how it fits into your bigger picture. So what we've done is we've brought in amazing resources for everyone here today. We brought in the top tax advisor, the top insurance advisor, and one of the top estate and legal advisors that we have in Bend. So I'm really excited to introduce them to you here in just a minute. But what I would like to do is get this started and hear from you so that we can have a good roundtable discussion. So I would like everyone to envision today as we're all sitting around a conference table and we're here for you. We have an agenda which we can present, but we're really open to your questions. Anything that you may have, like this is your dream hour of saying, hey, I've got all of the best of the best around me trying to help me understand how my real estate portfolio and holding and strategy works. And we're here for you. So Ronald, can you pull up the first poll? The first poll we've got here, let's get that live, should pop up on your screens here in a minute. And I'd love to hear, when you're thinking about real estate right now, what are you most concerned about? Out of the four choices that we have here, I'd like to get a little bit of a read on the room and see where your heads and hearts are at. It won't allow me to vote because I'm a panelist, but I know which one I'm thinking about. And the other thing about today is if you have any questions, what I would love for you to do is put them in the Q&A or the chat function, and we'll try to address those as we go along. So both of those should be available to you here in Zoom. So while you're doing that, I'd like to make an introduction to the first person that we've got here. I've been working with Cara a long time. She's an absolute ninja in tax planning and strategy. She helps me with a lot of my LLCs that hold real estate, my rental properties. And then she works with a lot of my clients that have dual residency or they're moving in and out of Oregon. And so she's just a wealth of resource, a great resource for all of us. And Cara, do you mind introducing yourself here?
Yeah, happy to. Hi, I'm Cara Pardue. The slide says I'm with Price Franck, which is mostly true, but recently changed. So Price Franck's been a CPA firm in Bend for 20 or 30 years. I've been with the firm about 25 years. But we just recently took a big step to offer a little better breadth and depth of resources to our clients. And so we're now part of a larger network of firms across the country under the name of Soren. So happy to be here, happy to answer questions. And thank you, Brian.
No, thanks for coming today. Sorry about that. I've always known you as Price Franck, but thank you. And then Ronald, do you mind pulling up the results of that before we jump on to the next thing here? Okay. Some people want to hear about insurance. Some people want to hear about taxes. Some people want to talk about estate, but by far and wide, they want to talk about property values. Well, we'll talk about property values, but we'll try to weave them into a bigger picture discussion, incorporating all of the above. Property values are obviously what people think about usually first, but then I think there's sometimes a lack of a better strategy around it holistically, and people forget all the intricacies in holding real estate. So that's wonderful. Let's go to our next panelist here today. We have Aaron McDonald. Aaron represents me personally, has helped me with estate planning, is an absolute amazing resource in town. And I actually used to ski patrol with her husband, caveat there. But Aaron, do you mind taking a second and introducing yourself?
Sure. Brian, thanks for having me. And I am an estate planning, tax planning, charitable giving planning attorney and have practiced here in Bend for over 20 years. My firm, formerly known as Carnot Peterson, is now Best and Krieger, like Kara's firm. We've gone through some transitions recently and are very happy to continue to provide business and estate planning and real estate solutions for our clients here in Central Oregon and beyond. So I'm glad to be here. I'm the estate planning component, but I love to talk tax. So I look forward to that part of the conversation too.
Oh, wonderful. Well, thank you. And finally, not least, Eric Jansen. He is an amazing insurance broker here in town, has been here a long time. And one of the reasons I felt it was important is there's a lot happening right now with insurance, with fire maps, with people not being able to get renewed. There's a lot of different things that I want to talk about today. So I think it's going to be really important to have Eric as part of the conversation. But Eric, would you mind saying hi to everybody?
Yeah, thank you, first of all, Brian, for inviting me for this webinar. Very excited. Yeah, my name is Eric Jansen, represent Team Jansen with Country Financial Companies. This year, 100 years old, and I'm super excited to represent them. And like Brian said, huge amount of challenges in the insurance industry in Central Oregon as well, and outside of Central Oregon. So love to chat more and be a resource for each and every one on this panel and team.
Well, wonderful. Well, I appreciate that. So let's kind of get to the nuts and bolts and get going. So I do want to talk about, what's happening really quickly. I'm going to take about 5 minutes talking about what's happening in real estate with inventory demand, what's happening with pricing, and then just because the other thing that we're hearing right now in the news is, are we going to go into a recession, et cetera, and just give a little bit of perspective on how real estate generally performs during recessions, and just to kind of give a little context to that so that we can kind of get that out of the way. And then we can get to what I'm more excited about, is talking about this holistically with all these amazing advisors that we have here today. In general, you've seen this slide before. This hasn't been updated for a couple of months, but this shows year over year price appreciation. And what this really shows is back from 2019 through, we see the pandemic, don't we? This is the craziness that we all experienced, where we went from kind of the historical average of 3 to 6% appreciation nationwide to 20% year over year appreciation, to that all coming to an end in 2023. And I'll show you here why it came to an end in 2023. But then things have been pretty normalized since that point. And that's what we're seeing here in Bend. So pulled up, and there's a bunch of different ways to measure median price in Bend. What product types you're using? Are you using rolling data? Are you using month over month? But we're about flat. So if we use all product types using this data source that we have here in the MLS, we're about 740,000, and we're up about 3.7% year over year, which is about what we're seeing nationwide. So this is normal, this is boring, and this is a much more stable situation than we've had dealt with in many years, and is definitely not the crash after the pandemic that many were projecting. And what the main issue we have in here in Bend is we continue to have more demand than supply. So even though buyers are fewer and far between because of the pricing, there's still pricing support, and we kind of came down off of those highs in a pretty balanced manner rather than a crash. The next thing I want to get to is kind of sales, because what you will often see in papers and the headlines right now is sales are down 30, 50% year over year. Where we're at right now, kind of year to date, this was January through April. So 4 months of the year, we had 770 transactions. We do about 2,500 transactions a year here in Bend. It's about flat. It's down only a couple percent over what we had last year. It's definitely down from, that same time in 22 or 23, we were over 1,000. We were 1,100 sales in that same time frame. So even though sales are down 30, 40%, it was really off of that astronomical high. And it's a pretty normal, pretty balanced volume here in the market. And the last thing I want to kind of talk about is inventory. So this goes all the way back to 2007. And the red line shows inventory as measured in months. When inventory got up to 30, 40 months, what that meant is back in 2008, 9, and 10, is that if no new inventory came on the market, it would take 30 to 40 months to sell through it all. And then during that pandemic, if you can scan to the right a little bit in 21 and 22, we had about a month of inventory, which meant that if no new homes came on the market, we'd be completely 100% sold out in about a month. So even though we see inventory going up 30, 50%, it makes a great headline, right? It makes a lot of people scared. We're still hovering under that 5-month mark. And that blue line that goes across the board there is what the National Association of Realtors defines as a balanced market, which shows about balanced kind of forces between buying demand and sellers. And we're just on kind of the low end of that. So it feels pretty normal. And the time that we've seen really big price corrections are when inventory starts to crest that 9, 10, 12-month inventory mark. And there's a lot of intricacies to that, but it makes sense, right? Like when someone's trying to sell their home and they can't sell it for a year, it takes 10 to 12 months to sell. That's when they start having price reductions or major price reductions. And so we're still at a point where we're normal, we're balanced. Prices are high, but we've got a pretty balanced demand right now. And we're not seeing rapid price appreciation or price depreciation in this market. The last thing that I want to talk about, and I have about 15 slides on housing and recession, is a lot of people are asking right now, what's happening if we go into recession? Won't houses crash? Now, I have the mortgage rate here charted back to the 1970s. Very few of us can remember the 1970s and 80s as far as a working professional, but interest rates back then were 16, 18%. But basically that vertical gray bar that we shaded in here was all the recessions dating back to the 1970s. And what we found in those is that in every single recession, mortgage rates went down because basically there's a lot to it, but the Fed basically tries to increase supply of money. They try to lower interest rates, the T-bills, everything kind of falls in line because the Fed likes to use housing to kind of work their way out of recession. When mortgage rates go down, home buyers come back, it puts people back to work. And, even in the, like if we go back to the 1980 recession, it started at 16% mortgage rates, it ended that recession at 11, et cetera, et cetera. 1991, it went from 11 to 8.75. Every single recession, at the end of that recession, mortgage rates are lower. Why am I talking about that? Well, this is my final slide. This is the number of sales. This is the same red bar that we looked at earlier, but yet I overlaid a dotted line here. What this shows is there's kind of an inverse right now between mortgage rates and number of sales. And so when we looked at, when interest rates are relatively low, kind of the majority of this graph in the middle with that dotted line, sales were high. And then when they started bumping those interest rates up in 22, 23, trying to slow things down, sales went down. And the reason I'm bringing this up is because as we go into an environment of a possible recession, and if interest rates follow the historical norm, generally that spurs selling activity. So just over half, about 70% of recessions, housing prices actually go up by the end of the recession as well. So I just want to kind of decouple that before we get into a bigger discussion, because a lot of people think automatically if there's a recession, housing prices crash. And it's like, well, maybe, but let's get into the data. And the way I'm looking at it right now is that housing affordability is the number one concern for buyers right now. And that if we see these interest rates come down, which is not a guarantee right away, but if these interest rates come down, if we enter a recession, I actually, from this position I'm sitting in, expect housing sales to increase. So I hope I didn't dump too much on housing. Hopefully that'll give some context for what we go. If that spurred a question, please put it in the Q&A and I'll try to weave that back into the discussion. But I think we're all here today to talk to the other experts. And let's start with you, Cara. You've got a lot to talk about today. We threw up, 4 or 5 points here that you had proposed prior to this. But if anyone has any questions for Cara, this is the time. Throw it in the chat. I'll be watching it. But if you wouldn't mind kind of talking a little bit of tax and financial strategy, and kind of starting with homeowner, kind of, what are some of the strategies they need to keep in mind as a homeowner, and then maybe we work it into kind of investor level.
You bet.
Okay, thank you.
Yeah. So as a homeowner, there's a few different tax deductions that everybody should be making sure they're taking advantage of. That's deducting your home property taxes, and assuming you have a mortgage on your home, deducting your home mortgage interest. So home mortgage interest is deductible on the first $750,000 of home mortgage debt that you have. That's the same limit whether you're single or married. And if you don't use up that entire limit on your primary residence, and you also have, say a second home, a cabin, maybe you even have an RV, a camper, or a boat with living quarters that have debt on them, all of interest on any and all of those can be deductible up to that $750,000 indebtedness limit. Really want to make sure people know about the personal residence gain exclusion. So this is upon the sale of your home after living in it 2 years. You get to exclude from taxation either $250,000 of gain if you're single, or $500,000 of gain if you're married. And one of the few ways to make tax-free income. So want to make sure people are always taking full advantage of that exclusion. There's no limit on the amount of times you can use that exclusion in your lifetime. So, if you're game to move frequently and use it every 2 years, that's up for grabs. You can also use it, have a home you've lived in for 2 years, you're ready to move out, move somewhere else, but you want to keep that home as a rental for a little while, maybe let it appreciate some more. You can rent it for 3 years after moving out of it and sell it and still use that full gain exclusion. So that's a great opportunity to, get some rental income for a bit, let it appreciate, and then still get that full exclusion.
Yeah, we often find a lot of people are rushing to sell because they're afraid that if they don't sell right away, they lose that capital gain exclusion. So that's an interesting caveat to that
Yep.
rule.
Yep.
What else do we have here on your slide? Is there anything else you want to talk about?
Yeah, I think there's just, if you're in the realm of being ready to become a real estate investor or already a real estate investor, you absolutely should know about, accelerated depreciation deductions on your rental properties, using cost segregation studies to maximize those deductions, and then all the tax efficient ways to exit your real estate investments. Most people are familiar with 1031 exchanges. You can also sell on contract to spread your gain out over a number of years and try to capture a lower capital gain bracket. You can use opportunity zone reinvestments, which are incredibly powerful and beneficial. And then everybody should know about a basis step up in death. If you die with appreciated property, your heirs and beneficiaries are going to get a sell at no gain after your death. So
yeah, there's what you just delivered in the last 20 seconds. We could have a 20-hour seminar.
Yeah.
But for those of you who own a rental property or thinking about owning a rental property, I think even starting at the basic rules of understanding, like even just take a screenshot of Kara's notes and start Googling those or whatnot, or reach out to her and have a meeting. But being able to look into passive loss rules, when you can be considered an active investor, when can you write off all your expenses against your income, and then depreciation of the asset is a big thing that a lot of people miss, because you actually get to depreciate the value of your property over time, whether or not it's appreciating or not. And that really can help offset a lot of those gains, which kind of multiplies your returns on the property.
Yeah, so Aaron just asked about expanding a little bit on the short-term rental exclusion. So for, sort of your Airbnb short-term rental homes that you're renting out, if the average stay is 7 nights or less, the IRS actually views you as operating a business instead of a rental. And because of that, you get to skirt or avoid all of the passive loss rules that go along with rentals. And so it's a great little caveat that as long as your rental period's short enough, you could be well positioned to take advantage of accelerated depreciation on the property and other deductions that can offset your other income.
Okay, so let's clarify that a little bit. So as a real estate professional, whether you're a broker or whatnot, or you meet the number of hours worked in the industry as defined by the IRS, you can there's a lot of good things with, being able to depreciate and, use accelerated depreciation strategies, et cetera. But can you go over that again with the short-term rentals? Let's say someone has a second home in Bend, they use it for a month or two a year. How does that treat it again, as far as them being able to use those tools for tax strategy?
Yeah, so let's set aside for just a second the personal use, because that can change the answer a bit. But if you have a rental home that is exclusively rented out for average stays of 7 nights or less, you fall under a different set of IRS rules. The IRS considers you operating a business and not a rental property at that point. And because of that, your losses aren't limited under passive loss rules. So once you start mixing in your personal use, you can have personal use of 14 days or 10% of your rented nights and not cause problems. But if you get too much personal use, those rules are going to change pretty quick. So
okay, well, that's really interesting, because then the IRS is saying this is a business, this is active, whether you're an active real estate professional or not, this specific property is, and you're able to do a lot more actively as far as tax strategy.
Yep.
Okay, before we switch over, Eric or Aaron, do you have any more questions for Cara in regards to any of the things that she's talked about so far?
I don't have any questions, but I was going to just start piggybacking off of some concepts that Cara introduced. So if we can just go into kind of an estate tax strategy session. So Cara mentioned that your income, so you've got a rental property that you're depreciating over your lifetime, and part of an estate tax strategy, particularly in Oregon, might be considering making gifts of assets of your appreciated real estate to your kiddos. And when we're looking at whether or not you should keep your asset, your real estate, or you should gift it, we look at what would be the benefit of getting that asset out of our estate for estate tax purposes, as compared to if we continue to own the asset at the time we die, the tax basis in that asset gets stepped up to the date of death value. So we're looking at estate tax savings versus income tax savings. And so one of the things that I do when I'm working with clients is I take a look at that appreciated asset. And if it's included in your estate in Oregon, it's likely to cause an Oregon estate tax. So Oregon taxes estates that exceed $1 million, which is one of the lower exemption amounts in the state. And if you happen to be a couple, if you're married, on the death of the first spouse, there's an unlimited marital deduction that we can benefit from. So often on the death of the first spouse, we don't have to be too concerned about Oregon estate tax, but we're certainly looking at, the joint estate and trying to minimize estate tax over the death of the couple. And so one of the ways to avoid Oregon estate tax is to give it away. And if you give an asset away, you give your rental property or your second home in Sun River or whatever asset we're talking about, it's out of your estate entirely for Oregon estate tax purposes. Oregon does not keep track of gifts. A little bit different in the federal paradigm, where if you make a gift, you must report it to the IRS. The federal exemption amount's $13.99 million. So if you make a gift of a piece of real estate, that's going to come off of your $14 million amount. The reason I'm bringing that up is because, if we're doing tax planning and you are not likely to sell the Sun River house, the second residence, it's a legacy property, it may make sense to give it away. Right? We're not going to worry about a basis adjustment if that asset is not likely to be sold. So for many families that I work with, there is a legacy property, and it may make sense to make a gift to get the asset out of the estate for estate tax purposes. So everything that Cara and I are talking about, right, we're going to defer to your own advisors, your accountant and your attorney. We're just here to issue spot. But the world that Cara and I walk through is one where we work together. So you want your accountant and your attorney working together, and we're going to be looking at income tax minimization versus estate tax minimization. Cara, do you have anything else to say about that? She's shaking her head.
Yeah, no, well said. It's definitely a combo planning process. Attorney and accountants working closely together is where you're going to get the best end result.
And I wanted to mention one other thing, Brian. You made a comment. I can't tell who all is on this seminar today or who might be listening in the future, but you mentioned dual residency. And I know that Cara and I both have clients that live in, spend time in multiple states. It's really, really important if you are, listening today and you are not a resident of Oregon, but you own Oregon real estate. Oregon taxes the estates of non-residents who die owning Oregon real estate. So there's a strategy for how we avoid Oregon estate tax in that situation. But I just want to, kind of like, I'll say it 5 times, right? Because people often don't know, and then they get caught with a surprising tax bill. And so the way that we work around that, so the way the Oregon tax code is drafted, Oregon taxes non-residents who die owning Oregon real estate. They do not tax residents who don't live in Oregon and die owning personal property. So what we do with the real estate is we put it into an LLC. And by converting that Oregon property into an LLC, now that decedent owns a personal property interest, not a real property interest, and we can avoid Oregon estate tax. So I'm just raising that when you're meeting with your attorney wherever you live, looking at how you own title to your real estate becomes really important, whether you own it individually, whether you own it in your trust, or whether you own it in an LLC. And in particular for non-resident decedents, owning Oregon real estate in an LLC can be very advantageous.
Yeah.
Brian, those were my two. Those were the notes that I wrote down during Cara's talk. So I don't know, I might have gone off course a little bit.
No, those were great. I was taking notes because I'm thinking about how I'm titled on various properties. So thank you for that. That was really important. The notes that you had, started with before we started today was, how to title properties for liability protection. I guess you were talking about it more from a tax strategy standpoint, but let's also talk about that from a liability perspective.
Yeah, so we just talked about using LLCs merely as a way to convert a real property interest into a personal property interest. But we can also use the LLC as a way to essentially silo assets. So let me give you an example. I might be working with a client and they have a multifamily property and two, residential real estate properties. What we can do is we can take those assets and we can put them into a limited liability company. And that way we protect the asset, or we protect our other assets from a liability that might be associated with the rental, with one or more of the rental properties. We might even actually create 3 LLCs. And by doing that, we're siloing the property and therefore siloing the liabilities and risks associated with that property. So instead of creating, sometimes I'll have a client who will come in who will be new to me, and they'll have created a limited liability company and funded it. But what they'll have done is funded it with all of their real estate, all of their rental properties, which doesn't actually get you the maximum benefit of having that division of the asset from the other assets. So we'll use LLCs and multiple LLCs as a way to structure and protect the asset. That being said, insurance, and this is in Eric's realm, but insurance is your first line of defense in terms of liability protection. And then in addition to your insurance policy and making sure you have adequate coverage, that's when we start talking about using a limited liability company as a way to give you a little bit of protection and shield.
Wonderful. Does anyone else want to jump in on titling the properties, or should we move? Oh, go ahead.
Yeah, go ahead.
No. Yeah, and I guess my next question we get a lot of questions about Oregon and federal estate tax limits and, kind of where are we at right now with the states in Oregon. There's kind of the saying that goes around, don't die in Oregon with real estate. Maybe give a little bit of background of kind of where that statement comes from, and then where are we at with our current limits.
Okay, sure. So the current limit is $1 million. That means each person has $1 million of estate tax exemption that they can pass on without having to pay estate tax. So if you have a couple and your estate is, let's say it's $5 million, and one of you passes away, First million, no estate tax. Everything above it, no estate tax because of the unlimited marital deduction. Okay.
And that's for Oregon,
And
correct?
that's for Oregon and
Yep.
federal. The difference between Oregon and federal is that the federal exemption is almost 14 million currently. And then anything above 14 million, you have an unlimited marital deduction. There's currently, last I checked, I think it was 9 bills in the Oregon legislature that are moving through the session. And they are all attempts at increasing the amount of the exemption in Oregon. It's some of them are to do an inflationary adjustment. Some are to increase it so that it's commensurate. It's the same level as the federal estate tax exemption. So it's a little early to see what's going to stick, what might make it through a little further. There's also a concept at the federal level called portability. So if you have one spouse pass away and they don't use some or all of their estate tax exemption, their 14 million, that can transfer to a surviving spouse. So they have double the estate tax exemption. We don't have that in Oregon, but there is an attempt to introduce portability into the Oregon estate tax code. So there's a lot of activity. I think it has bipartisan support at this point to increase. Oregon is one of the lower estate tax exemptions in the country. So yeah, to chip away at it, and I'll keep you posted. I don't know. I mean, I can't do research on all the bills because there's been so many, but
Yeah.
I'm sure something's going to stick and we'll see that float to the top at some point.
Yeah, thank you. I think there were a couple thousand bills introduced this session. There was a question here that popped up, and I think I understand what they're asking. They said, to place a property into an LLC entity, does the title need to be transferred into the name of the LLC as well?
Yes.
Yes. Okay, perfect. Another question. With the death of a spouse, say a couple owned a house titled to a couple that was 1.8 million, and the intent was to pass to their children, is there any portability, or should this be taken, or should this just be held in a different form?
So the house can pass to the kids. There in Oregon, if something happens to one of you and you're both on title, there's some magic language. Either you own it as husband and wife or tenants by the entirety. The preference is tenants by the entirety because that has creditor protection. Technically, in that situation, each spouse has a right to 100% of the house, and that's how you get creditor protection. So that's if you were to own it individually. Some people will own it in their trust, so their revocable trust. So while they're alive, they create a trust, they put the house into the trust, both of them pass away, the trust terminates, distributes to the kids. And there's also a third kind of approach to titling where you would own the house individually and you could list the kids as a beneficiary on the deed. So like an IRA where you've got your beneficiaries listed, you can do that with real estate. So that's how you would hold title and transfer it to the kids. The tax question, if your estate was only 1.8 million, so and each of the spouses have $1 million estate tax exemption, that would fall below the 2 million. And there's some things you can do in your estate plan to make sure that you use both $1 million exemptions so that transfer would pass without estate tax. But I want you to understand that $1 million is of everything. It's not just of real estate. So in my example of where you're a dual resident, like you're a Californian who owns an Oregon property that happens to be 1.8 million, the value of your entire gross estate is what we use to determine whether or not we have to file an Oregon tax return. So it's not the value of the Oregon real estate, it's the value of the gross estate. So again, for me, the key is really if you don't live here, but you own Oregon real estate, you should be working with an Oregon attorney to do some planning around that real estate. I hope I answered your question.
That was a great answer. There's a lot there, and there's a lot of variables that can be taken in. But I would like to get to Eric because we could go on with any one of you for hours. But then everyone listening, we're going to do rapid fire questions that all three of them are going to take swings at the end, and then continue to give us Q&A or in the chat function, and we'll get to that as well. But let's go to Eric, you have a deep experience in insurance, and you've been my go-to that when someone calls me and say, hey, the fire map came out, my insurance company called me and said, I'm no longer insurable. What do I do? And my number one reply is, hey, give Eric a call. But Eric, if you wouldn't mind introducing yourself, and then let's get to some of the questions that we have for you here today.
Yeah, no, these are great subjects that I've been listening into. It's amazing. We're talking about LLCs, properties and LLCs, and yeah, that's the stuff we deal with daily in the state. You know, Oregon is a beautiful place to live. It's not a great state to die in, right? But all that said, yeah, so I represent one company. It's Country Financial. Technically on paper, I'm not a broker, so I don't represent a whole bunch of companies. But the beauty that we have and the team that I have here in-house is when something doesn't fit in our bucket, we go above and beyond and really work with our prospects or referral partners to get you something that can help you get your home insured, or what is possibly going to become your home in the future. When we're talking about the Oregon wildfire maps, and I know that's been an extremely hot subject over the last 12 months, I've done probably 10, 12 different office visits, real estate office visits, and talk a little bit more about this issue and what the state of California, or sorry, state of Oregon has put together, and what the insurance companies are using. And to be quite honest, and this is just coming from my perspective, is we don't really care what the state of Oregon put together. We don't. We are using independent services and mapping strategies and as much as AI technology as we can, probably to move as fast as we possibly can on seeing how we want to insure risk in the state of Oregon. And I cover other states as well, but the state of Oregon is what we're covering here today. So the Oregon wildfire map, great what they put together. It's not impacting what the insurance companies are doing, but yes, in the last 2.5 years, insurance companies have done a lot of changing, a lot of fixing. And they're moving at the highest speed I've ever seen. I've personally, I've been doing it for 18 years, but I've been talking to people that have been in 30, 40 years in the business, and they're like, wow, the last 2 years have been ugly as far as wildfire risk and the seasons we're running into and the risk that we're seeing come across our table. So yeah, absolutely. A lot of stuff.
Yeah, everyone's asking about, hey, can they still get insured? Let's get to that. So can they be insured?
100%. There will always be an insurance plan. Now, if it's going to be with an independent insurance company, or there's always the Oregon Fair plan, it's not necessarily where we want to end up at, but there will be an insurance policy that's possible. There's going to be standard, non-standard policies out there. And then last resort would be the state of Oregon Fair plan. Yes.
And so the state of Oregon plan, if you can't find a provider, you have an extremely high risk home to insure. It does have some limitations on value and things like that, correct?
Yeah. I wouldn't want anyone to end up in that place. You will end up insuring just the dwelling itself, likely just honestly just a dwelling, and you end up having to get a liability policy. You'll end up having to get a personal property policy. So you end up with 3 different policies just to get going. Well, I always advise, and I advise real estate people, I advise prospects out there and people that are searching and looking around, reach out or make a contingent offer, knowing that there's an insurance policy in place, or being able to put it in place the day you're going to close on the deal. And that
so put a big note on this. If you're a buyer that's looking for a home, make sure to talk to your real estate professional and integrate into there a contingency that's saying my offer is contingent upon me finding acceptable insurance for this property, and if I cannot, I would like to terminate the contract. It's not in 99% of the offers that are out there right now, but the ones that are savvy and aware of what's going on right now are building that into their offer, or they're even talking to their insurance providers prior to making that offer.
Correct. Yeah.
Eric, how long does it generally take you to kind of give a thumbs up or thumbs down on the insurability of a property?
We can do it same day, 3 to 4 hours. It all depends on, we need some photos. We need some evidence. Yep. Yeah, we use a lot of third-party software, Google Maps, AI technology. Honestly, it's amazing the technology that we're using nowadays. A lot of these airlines that are flying from point A to point B have cameras on the bottoms of their airplanes. They're taking photos day after day, minute after minute, and that software is being used by insurance carriers, being purchased to figure out roofing issues, trees around houses and that kind of stuff. So be proactive so you don't have to react and maybe lose the deal.
That's great. And it's a little scary. Okay. Number two, rising construction costs. What are you seeing right now with underinsurance?
Yeah, this is crazy. As we all know, we're coming through COVID 5, 6 years ago with extreme increase of cost, labor cost. If we were talking about Central Oregon, we kind of live on an island here, right? I mean, as far as cost and people showing up doing the work, it's just at a different level. So the main thing that I talk to people about is, insurance companies don't insure land. We insure the structure that's sitting on the land. And with it's just how fast things are changing. Most, if not pretty much everyone, is underinsured. If you don't do an audit once a year on your insurance policy with your agent, and I just wish you would be working with a local agent because they know what's going on in Central Oregon or wherever you have your properties. They understand what things cost. We can say, okay, well, a plumber costs X dollars. A rebuild cost of a building is at $500-600 a square foot. It's not at $200 a square foot anymore. So you have to do this audit over and over, and it's a two-way street. You reach out to your agent, or if you work with a great agent, they reach out to you once a year. But yeah, you want to make sure that you are insured the day something is going to happen. All I wish for is that you're going to get to rebuild that house, but most likely it's not.
Okay. Now, the next question, it also intersects with the question that we had by Keith, basically saying, what are your recourses that you have if your coverage is dropped or you're limited to a level that you're not happy with? And then his question went on, I'm not sure if we can answer this, but what Fed or state protections are there for the insurers that are in the situation? Is there anybody looking out for them?
Well, there's a lot of rules and laws out there in Oregon for sure. What we've seen in today's industry is that insurance companies are going to look at risk they're not a nonprofit organization. We're in a for-profit business. We need to make money, and we haven't. Clearly, there's just a sheer amount of money going out. So what we are doing is insurance companies are going to look at areas. Are they the right risk? Are we needing to pull out of this risk? It's not like we're canceling. We don't cancel. Insurance companies don't cancel midterm unless there's something on paper that hasn't been completed, an inspection is not completed, or the inspection hasn't been followed up on. Then they have a reason to be able to pull out, but you're still going to get a fair warning on that. So insurance companies are looking at every square inch of the United States on where they want to do business. I mean, it's clear. We saw what happened in California. We're going into wildfire season. We think this is just the start of wildfire. Wildfires happen year round now, and insurance companies are just trying to figure out how to stay afloat. And so they have the right to pull away. They have any right to look at policies if they want to at renewal, and they're going to make adjustments. And that's your time to make sure that you review your policies, make sure that you think you have the right coverage today so you can rebuild tomorrow.
Perfect. And then we'll close this section, and then we'll go into the rapid fire for everybody here. But what are some steps that they can take to make their property more insurable?
Make sure you clear your property. I know that sounds, everybody thinks they are doing that. Make sure that you clear chimneys is one of the big issues. Fires start there. So we have chimney issues. We have clearing of property. Reach out to your insurance agents. Make sure that they're aware of your improvements. Make sure that they're aware of what you're doing around your home. Make sure they're aware if you put in a new roof on your house that you have replacement costs for that. So again, proactively reaching out to your agent, your office, to make sure that all the coverages are in place the day something happens. There's not a lot that you can do to clear things and make sure that things don't happen. It's just being proactive, being a good homeowner, and things will be fine.
Okay. Well, thank you. It's a scary time. I'm getting lots of calls personally about this, but so far, knock on wood, everybody's been able to find a new insurer if their insurance didn't want to renew. And as this changes, we'll continue to speak into this. But lots of great questions. The Q&A is starting to light up as well. But this was written for Cara, but anyone is welcome to join in. Are there any upcoming changes to tax laws, tax breaks, write-offs, et cetera, that potential buyers or owners of real estate should be aware of? Anything coming up regarding tax? Aaron, you addressed this a little bit, but anything that's kind of front of mind right now?
Absolutely. There's a huge tax bill making its way through Congress right now. It's called the Big Beautiful Bill, if you haven't heard of it. And it has really impactful tax changes. Part of it is just trying to make permanent some existing tax benefits and rules that would otherwise expire at the end of 2026. One of the big ones is reinstating bonus depreciation back to 100% instead of 40% this year, 20% next year, and then 0. So that's a great benefit for real estate investors. But yeah, this year's going to be a wild ride for tax law, and I think the best we can hope for is at least making permanent where we're at right now, with a few improvements, including the bonus depreciation.
Yeah, and we had talked about that bonus depreciation in the past, and for those that are active real estate investors and are not doing accelerated depreciation or even one step further bonus depreciation, it's time to talk to a tax advisor.
Yeah, and I'm just going to throw one other comment out there. If you bought a rental property in prior years and didn't know about or didn't take advantage of accelerated depreciation, it is not too late. You can retroactively in this current tax year go back and claim unclaimed accelerated depreciation from your year of purchase. So yeah, make sure you're talking to your CPA about that if you're in that situation.
Perfect. This
Brian,
one's for.
Yes. Let me hop in. So the tax proposal from an estate tax perspective. So I mentioned that we're currently at a federal exemption of about 14 million. That amount technically under current law is set to sunset in 2026 and return. So it was a temporary increased exemption. It's set to go back to about $7 million in 2026. So there'll be a lot of attention given, at least in my world, between now and the end of the year. The current proposal that's going now through the Senate has a $15 million estate tax exemption per person that is permanent. There is no sunset. So that's where we are in terms of the proposed legislation.
That's a big difference.
Mm-hmm.
That's half. And not great with numbers, but I think that's half. Okay, that would be a big change. Aaron, I think this is for you. I think we've addressed it, but it says for someone who is an Oregon resident, who owns multiple Oregon properties, should they put them in an LLC?
So I would, this is the classic attorney response. It depends. So if they're personal use properties, the play to put them in an LLC is really to convert them to personal property to avoid Oregon estate tax. But if you're an Oregon resident, those properties are going to be included in your taxable estate, whether they're in an LLC or not. If you are looking from a liability protection strategy standpoint, then it may be wise to put those into one or more LLCs to get them separate from your other assets so that if there is a risk associated with one, it's limited to the property that's held in the LLC.
Thank you. This one is, I assume it's for Cara, and I'm not sure if it's personal income or if it's property, but for clients who own property in 2 states, what's the key to avoiding double taxation?
Yeah, so there's an overarching state tax system that basically avoids double taxation. But what you're going to pay is the higher of the 2 states. So if you're a resident in one state, you own rental property in another state, you're going to pay tax to the state that the property is located in if they have a state income tax. In your home state, you're going to get a credit back against your home state tax for what you paid to the other state. So there's not going to be double taxation, but you're going to pay the higher of the 2. And if you live if you're a resident of a no income tax state, but you opt to rental property in an income tax state, then you are subject to state income tax that you wouldn't otherwise be subject to. So no double taxation, but you're going to pay the higher of the 2 always.
Okay, perfect. I'm just going to throw it out there. What should someone do if they co-own property with a family member or business partner? So I think that's kind of an open-ended question, but what would be the first thing that comes to mind when someone says, hey, I'm buying a property with my sister or my business partner? Where do I start? Where do I start my discussion?
You need an agreement. So
Okay.
If you're going to own the property just outright in your individual names, you're going to own it as tenants in common, and you would have a tenancy in common agreement. If you're going to own it in an LLC, you'll also have an agreement, operating agreement for your entity. But the idea is have the conversations about how you're going to take care of expenses. What if one of you wants out in the future? How are you going to handle the buyout? Have all of those kind of tricky conversations where if there's a crisis or things get heated or the relationship goes south, you've already hammered out the terms of your deal. So do it on the front end. That's my take. I don't know, Cara, do you have anything else?
Yeah, no, anticipate the worst and plan for it ahead of time, which, yeah, exactly what Erin said. Make sure you know what your exit strategy is even before you enter into the purchase agreement, which sounds crazy, but.
And trust me, it's fun to get into these relationships and properties together. I'm often on helping them divest, and it's not nearly as fun. And however great the relationship was at the beginning, it's usually a little more strained on the back end. So take the time to make those agreements ahead of time and hire those, like on the screen today. Here's one that would probably bring in Eric's world as well. Here, when working with a property owner or a potential real estate owner, is it necessary to match the liability limits to someone's net worth in case they're sued or if there's an accident on the property? And what other considerations are important regarding net worth and liability?
Yeah, that's a great question. My rule is, what would you rather do? Pay for a low cost liability policy or have the risk coming out of your pocket? The liability policy, slap an umbrella on top of it, which, they're available up to any dollar amount at this point, 5, 6, 10 million. Those are inexpensive compared to some risk that can come your way if something goes sideways. Yeah, and I have plenty of clients that have, and we've brought this up several times during this hour, is clients with 5, 6, 7, 8 different LLCs just to move that risk away. The home might be owned in their property, personal name, but everything else that they have is in a different LLC, and each LLC might even have an umbrella on top of it. It's the easiest way to do it. It's the cleanest way from the insurance side of things. And it's like a whole different entity just got, sued or just handling the claim.
So for everyone's purposes, if you have a rental property and you have your basic policy, when you go to get a renter's policy or a homeowner's policy, how do you classify it when you're an investor?
Landlord, something like that.
Landlord policy. What's your standard umbrella, kind of your liability insurance that comes with that policy?
So with Country Financial, I standard right at $1 million on every
at $1 million, and then generally they can double, triple, quadruple the size of that umbrella for that specific property.
Correct. And I really just asked the question, depending on what each of these are worth. I mean, if your personal assets are X dollars, we need to protect with X umbrella. If an LLC is worth X dollars, then we need to make sure, let's get the umbrella to be higher than what the net worth is or assets are. That way they can go after the umbrella policy. Let the insurance company write the big check.
Okay. Anyone else want to chime in on that?
I put a tip in the comments, but just if you do have a revocable trust and you have your house or any other property in the revocable trust, make sure that you communicate and get the trust listed as an additional insured on your policy.
100%.
I bet that's overlooked a lot, isn't it?
Yeah, we got a lot of that happen with the LA fires. Social media they just went crazy on that. But yes, we do want to know about trusts or parents buying houses for kids, etc. We want to know. We want to have everybody listed so claims happen cleaner, checks are written faster, and that makes the process easier at the end of the day.
Okay, and final question, because we're coming up here on an hour already. Wow. Question, are the DSTs, the Delaware Statutory Trusts, common in the Oregon market?
So I have a lot of clients who invest in Delaware statutory trusts. It's just another entity type, maybe similar to an LLC, but it's a trust structure and it allows different titling. So I've got a lot of clients who invest in them. Of my clients that invest in them, though, the properties owned by the DSTs, I haven't seen in Oregon. It doesn't mean there aren't any, but all of mine have been back east and Midwest properties that are in the DSTs that my clients have gotten into. So I'd say they're widely used as an investment vehicle, but I'm not sure about Oregon properties being inside of them.
I think that's right.
Okay.
I have clients that do them in lieu of a 1031. So it's
Yep.
it's a way to avoid capital gains on the sale of a piece of property without identifying the specific property that you're going to purchase. You can go into this trust and get similar deferral of gain. I don't look through those trusts to know what they're invested in. So I don't know where they're purchasing, but the strategy is used by my clients.
Wow, we've covered a lot today. There's a few other Q&As that are lingering, but I'd like to put a bow on this and honor everyone's time. Eric, Carr, Aaron, you are experts in your fields. Thank you for joining us today. And then for anyone here that listened, we're going to send out a recording of this, and then we'll also send out contact information of everyone herein if you have direct follow-up questions or you wish to retain their services. But thank you all for joining me. I even learned a lot here today, and I already have a to-do list to come back to you with when we're done here. So thank you all. Have a good afternoon, and please feel free to use any of us as a resource with your housing needs.